There's two things going on, right? With the debt ceiling debates, seems like we kind of kicked the can down the road a little bit down to December now. But then there's also the Fed tapering as well. Do you think that now that things have kind of been pushed back a little bit, does the debt ceiling concerns in any way impact the Fed tapering?
I mean, it really depends on how the market continues to react heading into the early November Fed FOMC meeting, right? In terms of the impact of just this short-term extension. If essentially it causes quite a bit of disruptions in both the bond and equity markets in the U.S. and the world, then it kind of the balance of risk suggests that the Fed could wait a bit more, even though from our perspective, the Fed is already behind the inflation, employment, and growth curve. They're well behind in our view. That's been our view for a long time. So that would be kind of my short answer.
What about for the jobs report, though? Is the bar not really so high, as Kathleen had mentioned just now, for them to actually kind of seal the deal on the tapering concerns or the tapering debate, and maybe even when it comes to hiking rates?
I think they're ready to taper, and it's not clear to me that one jobs report is going to be like a game changer, unless you tell me a story where it comes in like below, like 100,000 or so, whether that happens or not, the statistics are very volatile, but I don't think it's a game changer for them. Like I said, what they're focusing on, in addition to the labor market recovery, which is fairly solid for us, looking at real average hourly earnings, the inflation number, economic activity in the U.S. is starting to surprise again. They're just ready to taper, but I think the markets kind of, to some extent, will influence their decision-making heading into the FOMC in November.
Sailesh, that debt ceiling crisis averted for the moment, for the short term, doesn't mean volatility from now till later on, and also which assets are likely to be impacted.
Yes, that's a very good point. You notice all of a sudden this big pickup in 10-year yields. A lot of that has to do, in our assessment, with this debt ceiling issue. And how does it ultimately get resolved? So our view on U.S. 10-year yields is, we're at an average range of 135 to 170 this quarter, and we'll be at 160 to 185 in the first quarter of the year. So it will definitely impact market sentiment. And not only that, Haslinda, not only the debt ceiling, but this China-related issues, right? Whatever they may be, every day we get a new kind of policy change, policy reform, whatever you want to call it, policy flip-flop. That's going to continue in China. And at the same time, from our proprietary indicator, we have machine learning using that to track the Chinese economy by sector. It's looking bad. Continued deceleration. Next set of prints on the PMIs are going to be well below 50. So the China issues are there. We have the geopolitical risks out there in the Middle East. So there's plenty of reason that the VIX index, measure of volatility, pretty much goes above 25% for periods of time, right? So volatility this quarter is going to be very tough. Lots of volatility across asset classes in our assessment.